primary reason for writing this book is that there's no book like this that was available in the market when I wanted to learn about investing. This book basically covers everything, all the investment options that are available in the Indian market. See, mutual funds, I would say, is one of the best options available. You could invest that corpus into a mutual fund scheme and then have a systematic withdrawal plan. So every month you can withdraw the amount that you need. When COVID happened, the stock market crashed for a few months, and the drop was so sharp that either people stopped investing or they came out of their investments in equity, wondering where the bottom would be. Gold can also be a good investment option, and over the long run, it has given reasonably good returns. Money is not everything, they say, but money is a major part of our life.
Thank you so much, Virunji, for joining the Maverickman podcast. We really look forward to having a great conversation with you. Um, without any delay, I would just like to dive in and want to understand about more about the book that you have written, what every Indian should know before investing, and what prompted you to write this book.
Yeah, I think the primary reason for writing this book is that there's no book like this that was available in the market when I wanted to learn about investing. So you could say that I wrote the book for myself and for people like me.
Mhm.
And while writing this book, I realized that there were, so many people in my friend circle itself who were not aware of the basics of investments like me. So I don't have a background in finance or investments or any kind of money management. And I realized the hard way that if you don't manage your money, then uh, no matter how much you earn, how well you earn, it's quite difficult to make use of your money if you don't invest your money
Correct.
properly. And when I
Making
tried to
your money work
research
for
and
yourself. Yeah.
yes. So in concept and theory it sounds well, but frankly there aren't, as in maybe now there is, but when I started there was not so many avenues for us to understand how money could be made to work for us. Even now the scene is pretty
Correct.
complicated, although there are so many services, so
Yeah.
many
Yeah.
fintech companies, so much information that has come about. But wading through that information for somebody who's not trained or who's not who doesn't have a fundamental knowledge of investing is very difficult. So this, to say briefly, this book is for people who don't have the fundamentals of investing, who don't have somebody in the family or friend circle who can guide them through this journey. So this book sort of aims to be that friend, that missing friend in our circle, who can guide you on matters related to investing. So to briefly, to summarize the book basically covers everything, all the investment options that are available in the Indian market. So right from fixed deposits to government schemes to employee provident fund to public provident fund to senior citizen schemes, gold, and
Right.
things like mutual funds, health insurance, life insurance, these are related to investing. And if you don't manage these
Correct. Correct.
aspects well, then it could have a big impact on your investments. And even stuff like
Correct.
writing a will and making a financial plan. These are things that most
Correct.
of us ignore.
Correct.
We feel that we are investing, but if you don't have a plan in mind, then sometimes a lot of these investments get unstuck. And writing a will is also an important part of managing your money, because you do all the hard work of saving money and investing it properly, but if it doesn't go to the people whom you love, or they have to struggle to get the money that you have saved, then the whole point of making money also gets sort of wasted. So writing a will is also a very important part,
Correct.
and the book also covers how you could go about writing a will. So the book is like a
Yeah, yeah,
reference book. It's not
absolutely
a one-time read. It's not something you read and you keep it aside. It's a book that you could
correct,
keep referring to time and again. Every time you have to do an investment, or if
correct,
you come across an investment scheme, you can come back to this book and check out the whole concept behind that particular investment, the specifics of that investment, the taxation part, everything is explained in detail about each investment scheme, so that there are very few gaps that
correct.
will be left in your
So I think
understanding.
this is correct. Actually, I also came across this book a few years back, and when we were
Okay.
conceptualizing the idea of Maverick Man and the Maverick Man podcast, I had this thought in my mind that I would definitely reach out to you as one of our guests, because this book has been extremely helpful for myself as well. And as you said, right, this is a book which is more like a guide when you are doing these investments of your hard-earned money, right? You need to know what all different instruments are there, how do they work, what kind of returns am I going to get out of it. So this book is a very good reference and a guidebook which can help you understand all of those things.
Sure, sure.
So I want to touch a little bit more about and understand a
I'll
little
just
bit more
add one
about
point. I'll just add one
what
point.
are some of the. Sure, sure,
Yeah, I'll just add one point,
please
Abhishek.
go ahead, please.
When I say it's a reference book, now there are two parts to it. One is that I keep updating this book every 2 years. So the book is very it contains
Okay.
updated information about all investment schemes. It's not.
Up
It's
to date
it's
information.
currently its,
Correct, correct.
yeah, sixth edition. So over the last 12 years, I've written five editions, and this there's going to be a sixth edition coming out soon. The point is that there are so many
And this
things that
has
keep
been one of
changing
the
about.
bestseller books in this
Yeah,
this
yeah,
has been
yeah.
one of the
So
best-selling books in the personal finance space for quite a few years now.
yes, yes,
Yeah,
it's been
great.
regularly in the top 10 bestsellers list at Crosswords. And most of as in I haven't done any promotion, most of the sales has happened through word of mouth. So that means that people have been recommending the books to their friends and families. And I keep getting a lot of mails from my readers saying that this book has really helped them manage their finances, and
No,
that they have been recommending
absolutely.
it
I
to.
think, and that's the reason I also like this book quite a bit, because the kind of content it has speaks for itself, and the value that it adds to a layman like myself and so many others like us who are retail investors. They don't have that kind of funds to actually go out and invest, and they don't have also the know-how, right? So for them it becomes extremely important to um, find out those nuances, understand them, and then go ahead and make their informed choice. Coming on to the same point, actually, I wanted to, and the book talks about it in detail, but from your end, I want to understand and bring it out for our viewers and readers as well. What are some of the lesser known good investment instruments we all now know, thanks to a significantly high amount of media that has been put onto mutual funds? Everybody knows about mutual funds now, or at least have heard the term mutual fund, or the
Hmm.
stock market and shares and so on. But what are some of the other lesser known, a little bit lesser risk investment instruments which a retail investment investor can go out and put their money in and can get some good returns without facing too much risk in the process?
Yeah. So, see, mutual funds, I would say, is one of the best options available by far. The reason for it is that if you invest it correctly, if you select the right funds, etc., and if you have the right mix of equity and debt in your mutual fund portfolio, then you can safely beat inflation. Now, the kind of inflation figures that we see may not be exactly correct. When you, for example, you come across
Mhm.
6-7% as the inflation rate, but you look around and you see that so many things get costlier at such a higher rate. Look at education or healthcare,
High price, right?
even transportation. So just
Correct.
getting that basic 7%, 8% may not help you. Although that said, things like EPF, PPF are great investment options, which Indians have been using for a long time. Uh, the good thing about these schemes is that they lock you in, like an EPF and a PPF. And the secret to
Yeah.
investing actually is to stay invested for a long term. What happens for most of us is that
Right.
even if you invest in a good mutual fund scheme, is that when the markets really plunge, then people get scared and they break that, that compounding that is
Mm-hmm.
happening. Or
Correct.
even with
Correct. Correct. Correct.
stocks, when a company is going down and they are not sure about the longevity of for that company, they might take out that money. So that break that happens is one of the biggest problems that investors need help with. So anything that keeps you
Mm-hmm.
locked in, like I think even the NPS scheme is great that way, because they keep you
Right.
locked into that investment habit. That's great, because
Duration,
when
certain
time
duration.
flies,
Correct.
and yeah, 15-20 years down the line, you look at your corpus, and that's a very nice corpus that you have. And
Decent one. Correct.
yeah, so
So,
yeah, sorry, Abhishek, you want to say something?
so you
Or
you, you just mentioned yeah, you just mentioned NPS. Could you
Hmm.
explain to the viewers and listeners what is NPS and how can someone go ahead and invest in that?
Yeah, so
Especially for
NPS
people like
is
us,
about,
professionals these days,
yeah,
they have
yeah,
been
so it's
in
a new scheme.
private companies where you don't really have any kind of a pension, any
Yeah,
concept of pension per se after you are retired.
yeah, so I would still say that NPS is not an ideal scheme for generating pension, because the moment you buy a pension scheme, it gives you a monthly payouts, but the rate of return is not that great. So you could still manage your pension part
Hmm.
on your own. So the history of NPS is that it came to replace
Typically,
the
what is
guaranteed
the
pension.
interest?
The rate that you get, see,
Sorry,
with pension plans is
what
around
is the
5 to 6%. Yeah, 5 to 7% is
5 to 6%, which
generally the
is
rate that you get,
which is
which is
hardly
pretty
touching the
low.
inflation rate.
Yes, yes,
Yeah.
yes. So that's what. So instead you could, yeah, what you could do is you could invest that corpus into a mutual fund scheme and then have a systematic withdrawal plan. So every month you can withdraw the amount that you need from your
Mm-hmm.
corpus, and that works like a pension for you. If you've got a sizable
Okay.
corpus which you have created, then you could use that. So what I meant by using NPS is that NPS has two parts, tier 1 and tier 2. So in tier 1
Yeah.
is where your pension amount gets accumulated. Okay, and when you retire, around 60% you can withdraw, but 40% has to be necessarily invested in a pension scheme. So that
Mm.
40% will
Okay.
of your corpus will only earn you 5 to 7% of interest, as in that's
Uh-huh.
the pension that you're getting. But tier 2 is great.
And
It
you will
works like a
again you
mutual fund. It's tax free.
again
It's
that
tax free.
40%.
Yeah, it's
Again,
tax
the
free. Both are tax
40% that is
free.
uh,
Uh,
okay. Uh, okay. Okay.
40%. Sorry,
So
I didn't
that is
get
one
that question.
advantage compared to the mutual fund. That is one advantage which is there compared to, let's say, a mutual fund investment. At least you this is not taxable per se, right?
Ha ha ha. So that's
Compared to
what. So
what
it's
you
not
will be getting
taxable.
out of
That's
mutual funds.
yes. But the other part is that 40% will compulsorily need to be invested in a pension scheme. But NPS
Got it.
also has a tier
And
two.
you will be is sorry, is there some kind of a duration after which you can withdraw the rest of the 40%, or will it
No, no, no,
continue to
no, no,
be
no.
there in the
So
investment
on
in the end?
maturity, when you retire, suppose you've got 1 crore rupees accumulated, or whatever the amount. So
Mm,
60 lakhs you can
mm.
take out. That's tax free. You can do whatever you want to do with it. And 40%, which is 40 lakhs out of that 1 crore, will have to go in a pension scheme. So then you have to buy a
Okay.
pension from one of those listed companies, and then you get a regular payout
Okay.
from there. The whole
Out of
point
there.
of
Okay.
NPS was for the government to come out, or of that guaranteed pension that they used to pay.
Mm,
So which was a
mm,
huge
yeah. Yeah.
expenditure which governments were incurring.
Expense. Mm,
Yeah,
mm, mm.
because with the guaranteed pension, the government had to pay the salary, the last salary that the employees were earning. and with every change in the payment schemes, their expenditures kept increasing. But with NPS, it's a
Vinod.
contribution led. You have to contribute to your own pension,
Right.
and then depending on how much you've
Right.
accumulated, you will get the pension that you've earned for yourself. It so totally reduces the expenditure that governments had to incur. But for general people like
Got it.
us, it's also useful because it helps us locked in, and the tier 2 option is great because the expense part of it is very less. It's 0.01 or
So
something.
what is
Uh,
how is this tier two different from tier one?
two or three differences. One, that it's not tax free, so whatever you earn, it is taxable. Second thing,
Okay.
the cost of managing that fund is very less. So if you go to a mutual fund and you invest your money, they have expense ratios, around 1%, 2%, which is taken out from your earnings. So that means that
Okay.
whatever money you're earning,
So
it's
sorry,
reduced by that
I'll just
percentage.
have to stop you over there. So
Sure.
expense ratio essentially over here means is the amount or the commission which the investment fund takes out of your earning for
Managing.
managing the money that
Yes,
you
yes,
are giving to them, right?
yes,
Got
yes,
it.
yes, yes.
And
So
in the
which is
case
not
of
very
tier
high.
two, what is this?
It's like
Which is
point
not
zero
very high,
0.01 or
but
something.
what is
Yeah,
that in
it's like
point zero one?
1/10
Okay,
or
so that's like
point
one
zero
tenth,
0.01 or point
one
0.
tenth of
Don't know the
typical.
exact. So it's like almost negligible.
Mm-hmm.
So that means your entire amount is invested, and the return that you get
Correct.
is almost 100% of what you should be getting.
Got
So,
it.
and they work like
And
mutual funds.
in
It's like a very low expense mutual
okay,
fund.
got
So
it,
over a
got
long
it.
term,
And
over 15, 20 years, that 1% becomes a sizable difference.
amount. Yeah, yeah, yeah.
Yeah.
Got it, got it.
Yeah.
So I mean, every penny saved is actually going into your
Yes,
investment. So
yes,
that's a significant difference over a long number of years.
yes. And
And
compounding
in
does
this,
shock you once it, crosses
true,
a certain
true.
threshold. Compounding surprises you
Yeah.
very pleasantly. Yeah, yeah,
Not so unpleasantly at times when it is a
yeah.
commission.
Yes, yes, yes.
So this the tier two essentially works similar or essentially same as mutual funds, if that is the right understanding.
Yes, yes, yes. So you have options to invest in equity through them, or
Correct.
debt, or government securities,
Mhm,
and
mhm.
yeah. So it's almost similar. It's similar, you
So
can say. There's not a
the
major
again
difference.
is in the tier two also. Do you have to put 40% continue
No,
to be
no,
put
no, no.
into that,
You
or
can
there
withdraw
is
the
no
entire amount
such
anytime.
limitation?
No, you can withdraw
Anytime.
it anytime.
Okay.
But it is taxable. The difference is that this amount is taxable.
Got it. Got it. Cool.
Yeah.
So now let's come to the mutual fund itself. How should one approach mutual funds? What are some of the things that you should look at when you're looking at a mutual fund from a basic retail investor point of view, right? Every day there are some new funds coming in, or when you are trying to invest in an existing fund, what are the things that you should look at? Just from the basic layman's perspective.
Yeah, I think mutual funds SEBI has tried to simplify mutual funds, lately, but it's still very complex. They initially there were
Mhm.
so many different types of funds, and everybody came out with some scheme or the other, which was just slightly different from the other schemes that they had. But then SEBI, made a change to that. They said you can't have more than one scheme of a particular type. So that, okay, when you want equity, or when you want a particular kind of scheme, there will be only one scheme like that from each mutual fund house. But the simpler way to invest is that if you should invest in equity definitely, but go for index funds.
Okay.
Index
50/50 basically would be kind of an index which will be mirroring the performance of these collection of companies, and it will go up and down according to the
Yeah. So
performance of these companies. Got it. Got it. Okay.
yes, 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 yes. So similarly, there are small cap companies, there are banking companies, there are multiple indexes. So
Correct.
you could choose either one of these indexes or just go for Nifty 50 or Nifty
Okay.
100 or one
The
of
best
these,
performing ones, go with that.
indexes. And yeah, but do some research just to make sure that you understand how this whole the whole how the stock market works. Because it mirrors
Hmm.
the stock market, and there are lots of ups and downs.
Correct.
So it won't be a straight upward climb when you invest, even
Correct.
with mutual funds.
And I think
So,
that's
for
where your
example,
book will
during
be very
COVID,
helpful for the viewers to
yes, but
understand the stock market,
there's
to
also the
understand the
mindset.
nitty
Yeah,
gritties.
yes, but it's also a very psychological thing, as in all of us are wired differently. So all of us will, in spite of all the knowledge that we have, we all behave in different manners. So when COVID happened, the stock market crashed for a few months, and the drop was so sharp that either people stopped investing, or they came out of their investments in equity, wondering where the bottom would be. But there
Correct.
were some people
Correct.
who continued investing, knowing that
Investing.
this is a part of the cycle that happens. So those who kept on investing and didn't stop their SIPs, or couldn't, sell out their equities, they were so much better off, because
Correct.
when the stock markets rebounded, the
Made a
profit margins and everything,
was much higher.
portfolio value
Correct.
just rocketed. So, and every time it happens, we promise ourselves that we won't fall prey to that, but it's very difficult to stick the course, in spite of all the historical data that we have, because every situation is sort
True.
of unique, and every time we
Yeah.
face a
Yeah.
unique
No,
situation,
absolutely.
we don't know how to react, and we give in to that fear, or greed also, for the same factor, because greed also works in a similar way. When the stock market rises, people
Everybody
forget the
starts to
plan
pump in
and
money.
push in, pump in
Correct.
money, and then when it crashes, then they're left with all the stocks that probably don't make sense. And so that's where mutual fund investments help, because it spreads out your risk. And if you're investing through an index, you know that you will be investing in the better or the best stocks that are available in the market, and they have a higher probability of recovering
Correct.
first, and doing better than their other than the colleagues or other companies. So it's a safer way to invest.
Correct.
And then you should invest in balance funds and some debt funds to just balance out your whole
What
portfolio.
would be so when it comes to investing in mutual funds, SIP is one of the, I think, the most popular ways. If you could just
Yes.
also explain SIP, how does that work? One of the common misconception or rather doubt people have in mind is that, let's say if I start investing in a mutual fund is going up,
Mm.
and if you start investing at that point in time when the mutual fund is already up, and then later on it goes down, how will your investment fare in that scenario, right? Because um, wouldn't it then it becomes like an equity only? So how should one look at SIP? What are the key aspects of SIP?
Yeah, so the whole point of SIP is to do that, to spread out your investments over a period of time, so that these ups and downs that you face in the stock markets doesn't affect your investments. uh, there are pluses and minuses to SIPs also. the the plus part is that all these ups and downs gets smoothened out,
Hmm.
because even if you start, so shouldn't time your SIPs. The whole point is that you needn't time your SIPs, as you said. And if the market is high, people hesitate to invest, whether in stocks or
Correct.
mutual funds, thinking that
Correct.
this is not the right time. But that's the problem, as in you shouldn't time markets. But no matter how much you convince people, they won't invest, because they'll always think that they are getting lesser value if they invest in a uh, when the markets are at the
At
peak.
a high point.
But nobody knows when.
Correct.
Yeah, but nobody can predict whether that's the high point. Maybe it continues to move up, and then after a year you would you would feel that regret that you didn't invest earlier. So the whole point of SIP is that it removes that, regret and that doubt that you'll have. You can start investing anytime, and because SIPs make you invest over a long period of time, at least 3 to 5 years, you should invest at least. Ideally, you should just keep it going for 10 years or more. So then that effect of the market peaks and downs won't have any effect on your investments. The downside of it is that because it spreads out your investments, it won't have those spikes that lump sum investments has. For example, if you're able to time the market perfectly and invest when the markets are really down, like if it is at
Mm.
100 and you, for some by luck or in some way, you're able to invest at that point, and the market goes up to you know 500 points, or that stock value goes to 500, then the value of your portfolio becomes 5x. you know
5x. Correct. Correct.
but if you're spreading that amount over a period of 5 years, then you would have invested when it was 100, 120, 150. You would have stayed invested through the whole duration till it reaches 500. So your portfolio won't show that kind of a growth, you know
Correct.
compared to that lump sum investment where you had put 100.
What
You
is
had
a
exactly put the entire
typical
amount.
range?
Yeah, more than beating inflation is to stay invested. So what happens is, all the
Mm.
compounding that we're talking about looks good when you have a
Right.
sizable amount of money invested.
Amount.
Having just 1 lakh in your portfolio, and even if you get a 20% return, it will just be 1,20,000. But if you
Correct.
have 1 crore invested, then that 10% also looks good, or that having that money there is important. And
Understood.
we are talking about compounding, so it's not a flat 10%. it will
It'll
it
go
will
up.
be over a period of time. 10% is, yeah. So for example, if you've stayed invested at 10% for 7 years, then your money would have doubled. So if you have invested 1 crore, it would have been 2 crore by the time
Wow.
you've stayed invested
Correct.
for
Correct.
7 years,
Mm-hmm.
10%.
Mm-hmm.
So, but if you had just invested 1 lakh, then that 1 lakh, becoming 3 lakh also doesn't make a huge
That much
difference.
of a difference. Correct. No, no, absolutely.
Yeah.
Absolutely.
So important thing is to, if you want to be, if you want your money to really, make a difference to your lifestyle and to give you that comfort, then you need to stay invested. And that's the reason I say, even if you're not comfortable with mutual funds or anything, stay invested in your PPF or your EPF, because they also give you around 7 to 8%
Mm,
interest,
correct.
and they
Correct.
are tax free when you take
Right.
it out. And if you keep investing 1.5 lakh rupees in PPF, and invest a similar amount in EPF, and if you have a working career of 20 years or so, then those are sizable amounts when you are nearing retirement. The whole challenge is to keep investing as much as possible, as much money as possible into these schemes, and to stay invested. So I think I've heard a lot of
Keep that discipline going.
stories about people. Yeah, the discipline has beaten people who consider themselves smart investors, who keep going out in and out of
Mm,
stocks, but they hardly have any gains or portfolio to show, compared to people who've just stuck to very simple investment schemes, and they're pumped in as much as possible in those schemes. So the whole difference has
got it.
been the discipline, and that the consistency, and that regular infusion of money into these investments. So there'll be some
Right.
exceptions where somebody has made spectacular gains. They've bought the right stock at the right time, and they've pumped the right amount of money, and they've stayed invested. So they will look, their returns and their portfolios would look spectacular. But that's the minority, and all of us try to aspire for that.
That.
We hear of
Yeah.
1 lakh investment growing to 30 crore or
Correct.
50 crores, and we keep thinking that we'll be able to strike gold
We will be the
that
next
way,
lucky
but
person to
that's
get
not
that.
how it works.
Yeah,
Yeah, there will be like one in a million people who would
correct,
be able to achieve that, and
right,
mostly it could be a stroke of luck.
correct,
It will
correct,
be very
absolutely.
difficult for somebody to have, yeah, picked that right stock,
At the
kept
right
on in,
moment,
stayed
and
invested in it.
correct.
Yes, yes. So it's very difficult. So for the majority of us, I think it's the simple, steady way of keeping our money, in diverse investment options, even gold. That's the reason, I've a lot of people don't consider gold a very, what do you say, don't recommend gold as an investment option, a proper investment option. But,
Mm,
gold can also be a good investment option, and over the long run, it has given reasonably good
okay,
returns. So you should have it as
yeah,
part of your portfolio. It gives you that comfort factor when things are really bad, uh, whenever there's an unstable political or social climate, gold
correct,
suddenly jumps
correct,
up, and you can see
correct.
your portfolio getting
Because even
balanced out
now these
when
days,
you have
the
gold also in
yeah.
it. Yeah, Abhishek.
On the same point of gold investment, there is another instrument called sovereign gold bonds or sovereign gold fund, right? Something like that. Uh, how is that
Mm,
different from a physical gold, and what are some advantages and disadvantages if you go into that kind of a scheme?
yeah, so the advantage, there's a
First of all,
multiple
for the
advantages. It's
uninitiated, what is exactly sovereign gold bond?
So sovereign gold bonds are, they are. It's a scheme launched by the government of India to help Indians invest in gold indirectly. So they don't have to necessarily buy physical gold or gold jewelry, which has additional cost. For example, if you buy gold jewelry, then there are making charges which you lose out on. If you buy gold bars, then in substantial quantity, then you have to keep it safely. You can't keep them at home. You need to buy a locker, pay locker charges, be responsible for the purity, etc., etc. Yeah, selling it also, you'll have to incur some expenses on that. So SGBs are digital. It's just a digital version of buying gold. You don't get gold, but these bonds are linked to the price of gold. So it keeps track of the gold prices, and it will keep moving up and down as per the change in the gold price. And the government has sort of framed it as a long term investment. So you have to stay invested in it for 8 years. At the end of 8 years you could sell it, and the amount that you get will be tax free. So that's one part of it, one advantage. Second advantage is that you also get 2.5% interest on the amount you invested every year. So, that is something which we have never earned on gold. As in, if you keep gold in your locker or you buy gold jewelry, you won't earn any interest. So this 2.5% is free company sort of. You just
And that is also tax
get
free.
that money.
So, I mean,
It should be low.
still you are losing out. You still lose out
Yes.
on the money that you are investing. Instead, if you go for SGB, first is obviously you don't give any making charges. All of your money get invested, and second is it is
Yeah.
tax free, and the third is you
It's
get
safe.
interest on top of what you are investing. Great. Vinodji, traditionally, Indian families and Indian households or investors have typically looked at after gold. If another instrument that Indian household has looked at is real estate. Buying a house for especially for a middle class family or a lower middle class family is a dream. How do you see, or
True.
what are your thoughts on real estate as an investment? How should you approach that as a retail investor with not having that much of a liquidity which is required for real estate? How should someone approach that?
Yeah. So I think there was some RBI, study that was done, and they found out that the majority of Indians, the money that people had invested was majorly in gold and real estate, and then
Right,
fixed deposits, and those were the major investments. So historically, I think gold and real estate has been something that Indians have
prefer.
believed in, and
Correct.
yeah, and have preferred, and there are social reasons for it, I believe. Because gold and real estate gives you that kind of security which no other investment gives. This is historically.
Okay.
Now things have moved on. People have realized that there are better ways to invest your money, but that legacy or that mindset has still remained. Anecdotally, I think real estate seem to have given better rates than almost every investment. But when people looked at the numbers, they
Okay.
realized that stocks actually have beaten real estate almost everywhere. But owning a
Got it.
house, this is something related to social and psychological aspects. I think more than from an investment point of view. So it's a sort of a personal decision whether you want to buy a house or rent it out or keep renting it out.
Right.
So
And
so
let's say
there's no
if you have
hard and
to.
fast answer.
Got it.
Sure.
But if you have to, let's say, look real estate as an investment option where you are not putting like a very high amount, like a crore or something, to buy a 2 BHK, 3 BHK house, but a much smaller amount as an investment. Do you think that that would make sense, or still depends or vary upon a lot of other factors?
Yeah, so your first home, definitely the home that you're staying in, Abhishek, doesn't count as an investment because it doesn't earn you anything. It just
Correct.
appreciates over time. That's the only way you can look at it as an investment. So technically, uh, only when you sell that house are you making a profit. Otherwise,
Correct.
the increase in the value is just a notional value. You're not, you
Hmm.
in a crisis you won't sell your house and make money,
Yeah,
because
liquidity.
then
Correct. Correct.
yeah, you can't keep doing it. So the
Hmm.
first home is always, you can't consider it an investment because you won't be earning any rent also on it. It's just an investment because it appreciates in value. You can consider it as an investment because it appreciates in value. Your second
Correct.
homes and all can be considered an investment because you could earn money on it, through rent, or if you give it out as an Airbnb invest residence or something like that. But even then, rental yields are very low compared to the investment that you have made.
Correct.
So
Yeah.
for a
So
one
somewhere
crore
around two, three
investment,
percent, I think, annual
yeah,
return is
that's the
what you would.
standard rate everywhere, as in it's not just
Hmm.
India.
Hmm.
Although India probably gives the lowest rental yields. But even
Hmm.
I've looked at the numbers for real estate abroad, and they are around the same range. Like if you're getting 3-4,
Got it.
then abroad it is 4-5%. Commercial
Got
real
it.
estate still has a better value. So if you're planning
Hmm.
to invest in real estate, then you could look at commercial real estate
Might as well go
because
for
that gives
commercial.
higher
Got
yield.
it. What is the
Yeah,
typical
if
yield
you're
of a
looking at real
commercial?
estate, yeah, so if you're looking at real estate, then as an investment option per se, then maybe commercial real estate makes sense. Then there are newer forms of investing in real estate. REITs is a new way of investing where it's like a mutual fund. You don't invest directly in real estate, but there is a company that pools money and then
Hmm.
buys commercial real estate and rents it out, and that rent that
Sorry,
they
what is
earn
it
is
called?
given. REITs, real estate
REITs.
investment trust.
Real.
Yeah, and the
Okay.
dividend
Okay.
that
Okay. Okay.
the rent that they earn is given out to you as dividend. So it's sort of like earning, as in buying commercial real estate, because
Got it.
SEBI has mandated that they need to pay out 90% of their rental yields as dividend. So
Got
that
it.
company can only keep 10% for themselves. The remaining 90% they have to, a minimum of 90% they have to give out as dividends to you. So you are earning rent, you can say, indirectly. So
At a
these
much
companies,
lower
they'll buy out.
investment rather than at a
Yeah.
much
So
lower
in
investment
this,
than otherwise you
yeah,
will have
yeah.
to
So
do.
your investment amount can be lower, as in I think the minimum is 10,000 or
Correct.
something. So you can invest just that much and get some sort of exposure to real estate investing, and compared to investing
Got
in
it.
crores. or lakhs, tens of lakhs
Correct.
in real estate. Okay, managing real estate is also a headache. If you're looking at it as an
Yeah.
investment,
Yeah. Yeah.
you have to keep maintaining it, ensure that you get regular people to rent it out, collecting the rent, all those things. So the hassle that you
Yeah. A lot of
incur
maintenance is
compared to
required.
the return that you get is pretty low. And if you have bought real
Correct.
estate in a different city, then it adds
Then
to your
that's
headache.
yeah.
Keeping somebody to look after
Correct.
it, etc., etc. And you compare to the yield that you are getting, it looks sounds very interesting, and there are a lot of people who have made money through real estate, but probably this is not the time. There was a time earlier when real estate used to appreciate very high at a very high rate, but now,
Mm.
if you look at the recent reports, the either it has remained flat or it has gone down, or the increase has been minimal. So, as
Understood.
even the rate of appreciation is not spectacular. The rents
Not
are
that high.
already low, but the rate of appreciation has also been nothing to talk about. So I think so there are two aspects. One is buying a house and then looking at real estate as an investment. Buying a house, I think, is an individual decision. If you think you can afford it, if you feel uneasy about not owning a house, then you should look at fulfilling that aspect of your life. uh, Obviously, the economic part of it is important, because the moment you start paying those high EMIs, then you won't have, depending on your income,
Freedom to
if it is
yeah.
limited, then you won't have money to invest. And as I told you, the whole point of having a good corpus for retirement is having that continuous
Discipline
money
of
flowing
continuous
into your
liquidity.
investment
Yeah.
schemes. Yeah. So,
Good. Good.
real estate may not give you that kind of appreciation which a stock market or the other tax free investments that I told you about can give you.
Mm.
So will your real estate or will your home appreciate at 10-12% for 20 years? It's very doubtful. And
Unlikely.
then,
Yeah.
at the time of retirement, will you be selling this house and then going to move to a new house? That may not make total sense. So if there is a cash, as in if your money is limited, then I think uh, getting your investments in place, getting your insurance in place, that should be your first criteria, rather than getting saddled with a huge home
Loan.
loan and paying those high EMIs. It also adds a lot of stress, this
Correct.
EMI part. If you are
Correct.
unable to make a huge down payment, then the EMIs can be pretty substantial vis-a-vis
True.
the
True.
income you earn. So if
I
it is
mean,
more
even
than
if you
40% of your income,
yeah, I mean, the first part is minimum. Anyways, the minimum is 20% anyway, right? You will have to submit
15 to
20%
twenty
as a
percent is
down
the down
payment.
payment that you have to make.
Without that,
Yeah,
anyways, there's no. And if you're looking at a crore, 1.5 crore kind of
yeah.
flats
But
over here in
ideally, you should
Bangalore,
be paying at least 50%, so that your EMIs are not so
correct.
high.
EMIs are much
Yeah,
lower. So
so
that the
much
whole
lower
game is
than
that you need to
huh.
have that kind of a liquidity available to you, which is very very
Yeah.
difficult for any middle class family or anyone who is in the middle class. No, I mean it's a great point, and I think somewhere, and especially I see this in my age group, having worked in India, in Mumbai, in Bangalore, and a couple of other bigger cities like Hyderabad. People in our age, they tend to, and that is something of a mindset that has been carrying forward from our parents generation, that you need to have your own house, right? That comes with some kind of a security. And but what we don't really or people tend to ignore is that uncertainty that comes, or the stress that comes with those huge loans, heavy AMIs, and then you have to cut down on your current lifestyle, make a lot of adjustments over there. So I mean, it's a very stressful situation when you go into that kind of setup. If you don't have a high amount of liquidity, as you said, like a 40-50%
Hmm.
kind of a down payment, and then taking a loan on top of it. So yeah, yeah, totally
Hmm.
makes sense. You touched upon
One
another part.
alternative. One
Sure. Sorry. Go ahead.
alternative to this Abhishek is that you could buy a house in a city where you plan to retire or
To
something.
retire.
So maybe a
Yeah.
two tier or a third tier city where cost of a house is much lower.
Much lower.
You could
Correct. Correct.
plan to, because you want to have a house in your name, and then maybe down the line you could use it as a holiday home also. And
Correct.
then once you retire, you could, if you're keen on retiring in that place, then you could move to those that place. I think a lot of people are trying that option where they keep moving in and out of cities where they stay in rent, but they keep a house in a smaller town, which becomes a permanent house, and
Permanent
which they
house.
use as a holiday home, or they could rent it out also for a long term. And then
Right.
when they are ready to settle or retire, they move out to the time. And because there is always some appreciation, they could also sell it out as a investment later on.
Later
So
on,
that
and it
is
would not
another way of
require
looking
that
at
kind
it.
of a significant
That,
investment also
yeah,
upfront
it won't be a
compared to
yes,
a big metro like Bangalore or a Mumbai or a Hyderabad.
yes. So
Great.
that is
uh,
something which people are looking at.
Got it. One thing I want to touch upon is, and you mentioned it when we were talking about other instruments, insurance. Typically,
Yeah,
insurance, and when it comes to insurance, either life insurance or health insurance, is typically seen as an expense,
yeah,
and something that you should have, but people don't think enough about it as an investment instrument, or how it can actually help build an investment corpus at the end of your job, at the end of your
yeah,
when you're retiring. How should someone approach as insurance as a financial instrument, both life insurance
yeah.
and health insurance?
Yeah, I think the aim of insurance is simple: to safeguard your, finances. It's when people try to go beyond that, then that they get into trouble. So life insurance is simple. It tries to replace your, economic value. For example, if you're 30, then you have another 25 years of working life ahead of you. So ideally, your life insurance should compensate for those number of years,
That
the
you'll be
earnings for
working.
those number of years, should something happen to you. So it
Mhm.
shouldn't be too low a number, but it needn't be an exorbitant amount also. So it should just be
Mhm.
enough to cover for this exigency, this untoward thing, unexpected thing that might happen. So there are different ways of calculating that life value, um, but there are simple ones, complicated ones also. Simple ones suggest multiples of your income. So if you're earning an income
Mhm.
of 10 lakhs, then you multiply it by 30 or something, or 20, and you get 2 crores.
that
And then you say,
that is
okay,
the
I could
amount
take
that you
a.
should insure your life
You could,
for.
but it all depends on also on how much liquidity you have. That's what I'm saying. It shouldn't burden you. Your first
Got it.
priority,
Got it.
although it is insurance is a priority, you should also make sure that you live your life. So you could
Mhm.
start with a smaller insurance and then buy other insurance also. So
Got
a
it.
basic
And
insurance
are there
is needed,
different types
but
of are there any different types of life insurances
yeah,
also?
yeah, yeah. Yeah. There the two basic ones are term insurance and insurance that gives you some benefit, which combines
Hmm.
investments in it. So term insurance is a
Okay.
pure insurance. It is like your car insurance. If anything happens to you, then you
Hmm.
get money. Otherwise, you don't get any return from that investment. But it's also the
Returns.
cheapest
Okay. That money
insurance.
is only going
For a
in
30-year-old person, for a
as an
1 crore
EMI, as an
investment, I think
installment, and
it's,
only in case of exigency, in case of a
yeah, you do
particular
loss
event,
of life, they pay
you
you.
will get, in the
Yeah.
case of loss of life, you will get a money which is being promised at the beginning of the insurance. That's a term insurance.
Yes,
And what
yes,
is
yes. The
investment
term
based
insurance.
insurance?
Yeah, so there's some component of your the premium that you pay, the amount that you pay to manage your insurance. Part of it is uh, invested and
Hmm.
given to you back as benefits at the end of the insurance period. So if you survive
Okay.
that period, of your insurance, then you will get that money back,
Hmm.
depending on how it grew and how much that investment was able to earn. It's usually around 5 to 7%. Again, it doesn't give spectacular returns. Um but the problem with these insurance schemes is that you have to pay a very high premium upfront. For example, you if you take a 1 crore cover, then the premium might be 65 70,000, per year, which is a
Mm-hmm.
high amount compared to maybe
Correct.
10 12,000 in terms of
Mm-hmm.
term
Term
insurance.
insurance. Term
So
insurance.
yeah, so
But
term insurance
one
is
thing,
that is simple. Hmm.
sorry, term insurance. When you say term insurance, it is for life, or is it, or is it for certain number of years, and after that it will expire?
So that's what. So it's up to you how long you want to take it for. So you could take it
Acha.
up to 60 years, 70 years, 80 years, however much. The, every time you pay a premium, the insurance gets renewed. And that's with other
Mm-hmm.
insurance schemes also. If you stop paying premiums, it gets stopped. Term
Understood.
insurance obviously simpler, and because the premiums are lower, it doesn't put you into a difficult situation in case you're facing some financial problems.
Mm-hmm.
For example,
Mm-hmm.
you have a very high premium to pay, and you you face a financial emergency or a situation where you are unable to pay high premiums, then your life insurance cover sort of disappears. Then you are
Mm-hmm.
exposed sort of. But with smaller premiums, you can make those kind of, that
Payments.
payments are
Continue to
easier
make
to
the
do.
payments. Yeah. Yeah. Yeah.
Yeah, so
Understood.
that has happened, a lot of times where people face either due to loss of job or health issues or something. They don't, they are unable to continue their life insurance payments,
And all
and
that money
they
that you
lose that
have paid
cover.
so far will just go down the drain,
No, you
to sort of
if
put it.
you've paid for 3 years or more, then you get some part of it back,
Back.
but
Okay.
not in term insurance, but in other insurance. With term
Not
insurance,
in term
obviously it is
insurance.
gone, but with other
Got it.
insurance, you get some part of
Investment
it, but
based
it is
funds.
negligible. Yeah.
Mm-hmm.
So
So should
so
you have a
that's how
combination? Typically, how would you approach it? Personally, if you have to approach it, like you would have a
I
combination of these two.
so no, I would prefer to go for term insurance alone, because
Hmm.
managing multiple life insurance schemes is unnecessary. If you have one or two
Understood.
term insurance plans, that is enough. You have a date, you
Mm-hmm.
pay those premiums, and your life is covered. And then you can look at investments separately, where you manage your
Correct.
investments through these instruments. You have mutual funds, you may invest in stocks a bit, you have your EPF, your PPF, your
Mm-hmm.
gold, all those things. So you have a mix of those investments which you are doing. Why bring
Got it.
insurance schemes into
One
it?
more instrument.
Huh.
Understood.
There's tax benefits, obviously, which people associate with life insurance, but those tax benefits are also available with other schemes. Like if you invest in
Mm.
NPS, or with, what ELSS also gives you tax benefits. PPF gives you tax benefits. So all those things, we have
Do give us.
1.5 lakh, 50 lakhs get 1.5, 1 lakh 50,000 gets covered through those schemes.
Yeah.
So you don't have to look at insurance as an additional way. So
Got it.
important thing is to keep your investments simple,
Mm-hmm.
because then you will be able to manage it better.
Understood.
So
Understood.
yeah.
No, no, I think that's very helpful. Um, Now, one thing which is very interesting, which you talk about in your book, is one of the later chapters, is how should one approach making a will, or before making a will, how should one approach retirement planning? I want to first cover on that, and then the last part would be how should one look at getting into preparing a will and so on. And why is it important?
Yeah.
Because
So
I
I
don't
think,
think in India
yeah,
there
yeah.
is that much of a concept of will or anything like that, right?
Yeah, true, true. We get scared, talking about will, because it brings to us the idea of death,
That,
which
yeah.
nobody wants to talk about. And mostly, we used to hear about wills, when you're watching a film, and then you see that
Movies and all,
some
yeah.
extremely rich guy dies without a
Correct.
will, or he has made this will, and everybody's fighting for those assets. But it's not so simple. I faced it in my life itself, where
Mhm.
my dad hadn't left a will, so and we didn't have too many assets. But even for simple things uh, to get done after his death, it was quite a bit of a challenge.
Mhm.
And there are two parts to it. One is having nomination. Nomination ensures that the money or the assets that are held in the in a person's name gets transferred to the other person easily.
Correct.
Okay, but what
Correct.
a will does is it makes sure that those assets go to the people that you want those people to get. So a nomination
Okay.
is just one part, but a will is the other part, where you make sure that it goes into the right hands. Sometimes we just indiscriminately write one person's name as a nominee for everything,
Yeah.
but
Yeah. True.
yeah, so that person, uh, you know we feel that that person will get the money, but technically that person is not what do you say is not the rightful yeah, successor for those assets.
Mm-hmm.
In the absence of a will, the assets of a person gets divided as per different acts. There is the Hindu Succession Act, there's the Indian Succession Act,
Acha, acha,
there's the
acha.
Muslim personal laws. So there are
Mhm.
so many of these laws that come into the picture, and
Right.
the assets get divided as per that law.
For those laws.
Um,
Okay. Okay.
yeah, so that can get complicated if people start claiming for it.
Mm-hmm.
Okay,
Yeah.
so
Yeah.
if there is a fight in the family, then all these laws come into picture. But if there is no as an but that's not the major problem. The problem is getting the assets also transferred correctly.
Okay.
Okay, there are two or three parts to it. One is the fights within the family that happens, in case there is no
Mm-hmm.
will left. Um, uh, then the assets gets distributed as per these succession laws. So uh, some people whom you would have wanted your assets to go to may not receive those assets, and some people whom you
Mm-hmm.
wouldn't have wanted
Want to?
to get anything would get probably the majority of the assets that you have created. So a will sort of gives you that peace of mind that the rightful people get the assets that you want them to get. And secondly, they can avoid the running around that
Hassles.
gets involved when
Yeah.
they have to deal with institutions, whether it's
Mm-hmm.
banks or other financial institutions, or the registrars of land and real
So yeah.
estate, all these things, yeah, so on. So a
So
will sort
would you
of
recommend like
protect.
would you recommend a late 30 guy or a early 40s also to get the will done, at least one kind of a
Yeah, because the moment
version
you have
of it?
assets, you should get it done. Yeah, it's not the age
You
as
should
such.
get it done.
The moment you have assets under your name, you
Acha.
should get it done. If you have a
Got
house,
it. Got
some
it.
stocks, dividends, etc., etc., and it's more of a
Mm-hmm.
safeguard mechanism rather than anything else. It doesn't
Correct.
take
Correct.
away anything. It doesn't take any extra effort. You just have to pen it down, get some signatures. You don't have to register it or anything. Just write it and keep it
Oh,
in a
acha.
safe, or just hand it over. Yeah, that's it. And just
Oh,
get two
okay.
witnesses
That's
to
all.
sign it.
Oh,
Yeah, yeah, because
understood.
then it sort of
Understood.
you anybody can use it, and then the amount of hassle it saves for the survivors is unbelievable. That document, even if somebody challenges that document, a court can look at it and get it authenticated,
I mean,
because
yeah,
your
it won't be that
signatures,
easy
your
in
witnesses,
the absence of
in the
a
absence of
will.
a will,
It would be
yeah,
very difficult. Yeah.
then it is
Got
very
it.
difficult. Then you have to go into history, then you'll have to look at who gave it to whom, whether it was inherited,
Mm-hmm.
whether who gave that
Correct.
money for it. As in, all sort of complications come into the picture which you wouldn't have dreamt of. The moment
Got
somebody
it.
writes
Got
that
it.
will,
Mm.
almost everything just evaporates. Nobody can make a claim
No, I mean, it's very
uh,
difficult to then
unnecessary.
question it and make
Yes,
unnecessary claims.
yeah.
Got it.
And your
And
survivors and your
while we are on
beneficiaries will
top,
have a strong. Sorry.
smooth sail. Yeah, correct. So while we
Hmm.
are on the topic of will, just want to understand, in India, do we also have inheritance laws and inheritance taxes also with the things that you get, let's say,
No, there are no
as inheritance?
inheritance tax. Yeah, no, no, no. As far as I know, although
Oh,
a CA would be the best person to write this, but if you sell or if you earn profits from that inheritance, then that is taxed.
hmm.
So, for example,
That
if you
is
inherit
obviously those
land,
will be taxable.
yeah, that will be taxed. Yeah, but otherwise, if you
Got it.
inherit
Got it.
land from somebody, your dad or your blood relatives, etc., that is not taxed. You get
That's
it.
not taxable.
Uh,
Got it. Got
yeah,
it.
there's no
Got it.
tax on that.
Perfect.
Yeah, so these
No, so I
succession laws
think
are also interesting. I've covered it in my book, as in what
uh,
happens if you don't,
put a will together.
for example, the land that whatever you've inherited, you can't, give it to somebody else. Your blood relatives, they have to get it. There are a lot of other things. It's all in the book. I'm not able
Hmm.
to recollect everything right now. But yeah, not leaving a will can get very complicated. Can make life very complicated.
No, I think that's why the book is so interesting because it covers almost all the very relevant, and sometimes people think, and if you look at a lot of information on internet, you will find all high funda information of option trading and yay and
Yeah,
all
yeah,
of
yeah.
those jing bang and jazz. But these basic things is is nobody is really covering it, and as a retail investor you again have to go out and find those things out. And but instead of that, if you have a book like this, you have all these things handy, and the good thing is that you have been updating it every 2 years with all the relevant up to date information. So that's been extremely helpful. And before we wrap it up, I would want to understand from your side, as you have been investing over the years, what are your top five choices of financial instruments where you invest, and has helped you, let's say, increase your wealth over the years?
Yeah, so I'll start with an admission here that I understood investing pretty late in my life. As in, it's one of the
Hmm.
regrets of my life that I had to go through this pain of not knowing how to manage my money during the first half of my life and my professional career, and that was a
Right.
huge opportunity that I lost. So I did almost every mistake that uh, a person could do. I bought
Uh-huh.
life insurance which was mixed with investments, those endowment schemes. I invested in stocks that didn't have any future. I
Hmm.
put most of my money in fixed deposits that didn't grow, over a long period of time. So it was a very bitter kind of a learning for me. And I am a writer, so I'm used to reading a lot, and somehow this whole genre of financial investing was something I was never exposed to. So I've read
Hmm.
almost all types of books, but somehow I didn't come across any interesting book on investing. So I
Hmm.
realized that unless somebody tells you how to invest in the right manner, you can pretty much go about life without knowing that, and making
Yeah.
those same mistakes for a long period of
Mistakes.
time. Yeah. And
Correct.
one of the
Correct.
reasons for that is that most of us are scared about numbers or financial terms or talking to people from this industry, because half
Yeah.
of what they say doesn't make a lot of sense to us, and we sort of blindly believe whatever they share with us. And
Correct.
so my first half has been, of my life has been a series of blunders, and the second half is writing this book, understanding how money works, understanding the world of investments, and I can now say that I'm reasonably comfortable with managing my money. And
Hmm.
although I'm not a rich person in a traditional way, I can say that I'm comfortable with the way my portfolio or my prospects look, and part of it is because that fear of money has sort of disappeared, and which is important for, I think, people to get into that right relationship with money. And when I say fear about money, is the fact that your investments go through ups and downs. Sometimes you may not
Yeah.
do
Yeah.
very well on your career front. Sometimes your personal life is also affected because of multiple things.
Mm-hmm.
Your investments may not be steady, and sometimes the market also behaves very irrationally, and you
Correct.
wonder what is happening to your investments. So for that fear to go, you need to have an understanding of how this whole financial world works. So because I'm sort of
Mm.
understanding it better, that fear has disappeared. So whenever, for example, during COVID-19 and all, I knew that things would get back sometime or the other, you know, to
Right.
normalcy. Uh,
Right.
that this may not be the end of it.
Correct.
There is going to be light, and you, you don't have to give up on, investing, etc.
Yeah. I
So
mean,
that
moving out the
comfort.
all the money out and all. Taking
Yes,
panic
yes, that
actions.
panic reaction that happened, that has stopped. That
Mm-hmm.
I'm able to control better. So those are the pluses of investing some time and effort in understanding how money works. And uh, the book that I've written, it's not a very easy read, as in it's not something you can pick up and keep reading in one go. It is difficult to read.
Yeah.
um, yeah, and you need to concentrate because every time, every few pages, you have to deal with numbers, etc. But I've tried to simplify it as much as possible, so that you can understand as much as possible about each scheme and investing per se. The whole idea is to when your understanding is clear, when your understanding is you have a thorough understanding, then things become simpler. That's the whole point. It's only
Yeah.
when you have a very hazy notion of things that you become worried and unsure. So
Yeah. I mean, you
the book.
either take hasty action if you don't understand things, or you don't take an action.
Yeah,
So,
or you just freeze, not
yeah,
knowing
you
what to
free,
do.
or you will just like, for example, in this scenario, investing scenario, people would just put the money in FD. कि यार नहीं समझ में आ रहा अभी कहाँ डालना है. Let's either put the money in
Hmm.
FD, or I will put it in some stocks, and then you don't really know as to when you are at the short end of the stick. If you don't really understand the
Hmm.
investments and have the basic understanding of how money works, as you were mentioning. So yeah, from that point of view,
Yeah.
I think this book is extremely important and useful for every retail investor.
Yeah, and in my personal investing, what I do is I don't have to follow. I don't know. I'm not swayed by, the stock market's movements, or I'm not influenced by stories of people making a lot of money, or this quick buck schemes, etc. Because you know that this is not how investing works, and you are invested for the long
Correct.
term. So you just have to stay your course, keep revisiting what you have invested, where you have invested, and just make slight course corrections. So a particular
Got
scheme is
it.
not giving you the kind of return, so you move slowly out of it. First study that makes to make sure that there is something fundamentally wrong or not with that scheme, and then you move
Mm-hmm.
out of it, steadily. So there is no hasty decisions to be made just because there is some news
Something
that
is not
has come
working.
to you, or you hear
Yeah.
about something, or
Yeah.
gold is going to go up, or stock markets is going to crash. You can
Yeah.
react at your own pace. You can take slow decisions, wise decisions, because this is a long journey and you are in it for the long run. So that's the kind of behavioral changes that come into you when you understand money. And
Yeah.
don't aim for the spectacular, aim for steady, being
Mm-hmm.
consistent and regular with your investments. That's
Investments.
yeah, that is the the fulcrum. That is the main part of yours that will contribute mostly to your success, rather than the high returns or the spikes in certain stocks. It's always going to be how long you have stayed and how much you are able to contribute to your portfolio. That's going to be the decisive factor. So 1% or
Got it.
2% here or there, can make a difference, but it won't be the major difference. Whether
Yeah.
you've been
Yeah.
able to contribute for the long term and whether you've been able to contribute the maximum possible is going to make that difference, not that 1 or 2%. So
Got it.
that's the yeah, change that I have brought into myself, and I invest in almost all these schemes that I've
You
mentioned in my
mentioned.
book.
Okay.
Yeah,
Okay.
right from PPF to some gold, some real
Hmm.
estate, some a lot of it is the major part of my portfolio is in mutual funds.
Uh-huh.
You can say around 60% of it is in mutual funds,
Got
20%
it.
is in stocks, the rest is in um, debt, gold, and some real estate.
Got
So
it.
yeah,
Got it.
that's how I got. But
Cool. I think we'll wrap it up at this juncture. Thank you so much, Vinodji, for joining us, and it has been a great pleasure talking to you. Um, we will again connect sometime. Maybe have there is a lot of content in the website on the book. Sorry, there is a lot of content in the book, and we can revisit again and have probably another podcast to talk a few instruments in detail and discuss that more. I
yes,
think
yes, yes.
that would be worthwhile further. But thank you so much for joining us, and we look forward to giving value to the consumers. And I think your book would be a great addition in anyone's journey to becoming a good investor and getting good returns. So, thank you so much for bringing this up, and thank you so much for joining us on the podcast.
Thanks, Abhishek. I hope I have been able to add some value to your listeners' life, and I sincerely hope that people take out the time to manage their money better. Uh, Not
Yeah,
necessarily from my book, from any other source that they trust and they believe in, because how they manage their money is going to have a significant effect on not just their life but also the lives of their dependents and the people who are dependent on them. So
correct.
managing money is not everything they say, but money is a major part of our life. So invest
True, true, true.
wisely,
Yeah.
look after your money. That's it.
No, no, absolutely. Absolutely.
Yeah.
Thank you, sir. Thank you so much.
Thanks.